Hello everyone, welcome to day 2 of webinar for performance management. This is Rizwan Mania. I hope yesterday's session went good for you people, and the techniques that I wanted to communicate went good, and it will give you the confidence, and yes, it will improve your drafting skills. Because as I mentioned yesterday, I will be focusing on weaker areas of the student. I know there are a lot of things that students are not aware about, so that's why I'll be focusing on that. A quick hello to everyone. If you can quickly confirm me, is my voice clear to the audience, and can you see the screen clearly and the video, obviously, please. A quick confirmation from you people. Okay, thank you very much for your confirmation. I hope you all are good. So guys, are we ready to start? Say yes. Okay. Now, another quick reminder as to how I will be completing the topics in the webinar. Day 1 was for budgets. Day 2 is for variances and small things that we have to complete relating to yesterday. We'll complete that as well. Day 3 is decision making. Day 4 is very crucial performance measurement. So make sure that you people are available on day 4, because day 4 is the most crucial for your paper, because you obviously will see a 20-mark question coming in your exam. Okay. Day 5, performance measurement and advanced costing technique. And as I mentioned yesterday, every day our focus will be to cover 40 to 50 marks. Yesterday, because it was the first session, so I had to tell you the analysis, the common mistakes. So that's why yesterday we were not able to complete our target. But from today, yes, I'll try my best to complete the targets. Today's agenda is very important. First, we will have a quick overview about participation approaches. Then we'll move towards section A, OTs. Then we will have an overview of learning curve. Then we will switch to sales mixed quantity variances in part of variances. Then we will be doing past paper for section C, a 20-mark question coming up, the latest question of exam. And yes, I will teach you how to do calculation on a spreadsheet in a very easy manner, and I will teach you how to draft the theory. And yes, the way I'll teach you, it will become a piece of a cake for you how to draft the theory. Then we'll be starting with planning operational variances overview, and then we'll be solving another question of constructive response, and then we'll be solving section B question as well. So today's session is a mixture of section A, section C, and section B, which I've planned in such a way that it will give you the idea about the complete syllabus and the section as well. So guys, it's all ready to start. Before I move, a quick one. The first WhatsApp group has been, it's complete. Now no one can enter the first WhatsApp group. So those who are new to the session, okay, those who are new to the session, who are not part of yesterday's session, and they are not part of my groups, kindly at this number, as you can see below, as this number, you can just share. You just send me a WhatsApp message, and once you will send me a WhatsApp message, then after the session I will share the link of the new group with you people, so that you can become part of that. Okay, so those who are new to the session, please note down this number and just WhatsApp me. Now, yeah, this time break as well. So people were, asking a lot yesterday, breaks. I've decided the time so that you should know 5:30 to 5:40. We'll have a 10-minute break as well. Here we go. Participation approaches to start with first. Now, there are three participation approaches. One is imposed style, second is participatory style, third is negotiated style. A quick overview. My friends, one is imposed style. Now, in imposed style, what you do? In imposed style, the top management, the senior management prepares the budget and then communicates the lower management. Does lower management has any input in this? The answer is no. Lower management has no input in the budgeting process. It's the top management that imposes without any participation of the lower employees. So this is known as imposed budgeting style, which is suitable when, now let's have a look. Suitable in case of small businesses, yeah, it makes sense. Newly formed organizations, exactly, it makes a lot of sense because those are newly formed, so we need the direction of the top management. And in organization where operational management lack budgeting skills, this is also correct because if the lower management doesn't have the skills, so in that case, they will not be able to make the budget, so they need the support of the top management, and then impose is a good option. The opposite of impose is participatory budget. So what is participatory budget? It is bottom-up budget. In this style, the lower management prepares the budget, they set the targets, and they submit those targets to the top management. The top management then will finalize the budget. So yes, it's the lower management that prepares the budget and submit that to the senior management. So is it a good method? Obviously, it's a good method because it will definitely motivate the lower staff who can take, who have the opportunity to give their input into the budgeting process. And when they are giving their input, this means they have the motivation to achieve it. When I ask you, what is your preferred method? And when you tell me your preferred method, this means you tend to ensure that you achieve that method as well. So it has motivated you to achieve, and the targets that you will make, you will ensure that you complete those targets. So let's see its suitability. Suitable for well-established large organizations where you can trust your lower staff, where operational managers have the required skills. So to be honest, if operational management has the required skills, so you can trust them and they can make a realistic budget, then the senior management will approve it. So these are the two extreme. One is top down, where senior management prepares the budget and just communicates to the lower management. Second is bottom up, where lower management prepares the budget and submit to senior management for the approval. We have seen the suitability. So between these two, let's try to find out. The third one is negotiated style. Now, what is negotiated style? So this is a style in which both the parties, that is the senior management and the lower management, will have a discussion and will try to find out the middle way. Let's take a very good example. Now, I'm the senior management in this class, to be honest, right? And I gave you a target that my students, you have to bring 80% in performance management exam. So are you ready to bring 80% in performance management exam? Yes or no? So let's see how many say yes. Come on. How many of you are ready to bring 80% in performance management paper? I can see very small amounts of yes here. Yeah, people are ready. Strange. Okay, now let's change by looking at your reaction. 95% in performance management paper. 95%. 95. Okay. So let's talk practically here. 95%. So in return, you were like, hello, what happened? We can't bring 95%. It's not possible for us to bring 95%. So I said, okay, now you tell how much you can bring. So in return, you said 50 seems to be okay. We can bring 50%. Wow, 50%. Okay. So I said it's too low. The senior management says 95, the junior management says 50. So one is saying a very lower one, the other is saying a very higher one. What to do? Let's have a table talk. Let's have a table talk and let's discuss. Then we will find out the middle way. And what is the middle way, friends? Okay, so what do you think? What is the achievable percentage for you people? Let's see what you say here. Come on, quick ones, quick answers. Okay, so let me select the average, what you're saying. Let me see, I'm the senior management and you are the lower management, right? Let me see the suggestions. Very few suggestions are coming here. Okay, so let's make a deal. Is 70% okay? Come on, friends, is 70% okay? The answer is yes. So this is negotiated style. No need to learn this. It's very simple. This is negotiated style where both the party came to a middle way and they had a discussion and they found out the middle way. So yeah, these are the participation approaches. Impose budgets. Top management imposing. Now let's quickly discuss the positives of imposed budgets. Positive or imposed budgets include, I would say, the experience of senior management will be incorporated into the budgeting system. Senior management has the experience and they know the strategic plans, so those will be incorporated into the budget. But on the other hand, what are the negatives of imposed budget? So the negatives are demotivation for lower management. Yes, obviously demotivation, because their input was not considered and it was just an imposed style. Hello, this is your budget, I need 100 units, that's it. So nobody is asking you, so it will demotivate the employees. However, coming towards participatory budget, so what are the positives of participatory budget? I can easily say motivation for the employees, because they know that they have the input into the budgeting system. So yes, they will be motivated for sure. But the biggest issue, but the biggest flaw is what? Is that they might set easy targets for themselves. They might manipulate the things. When I ask you to make a target for yourselves, so what you did, you said 50% is okay. See, this is manipulation. You are making easy targets for yourself. So yes, this is the case. You will set easy targets and this is manipulation. So my friends, participatory approaches are done, and do listen. My technique in this entire webinar will be, first I will give you an overview of the topic, and then we'll be quickly moving towards the past paper question, so that I will just show you the application of that. This is what I did yesterday as well, where I just gave you the recap of rolling budget and we quickly went to the topic, sorry, the past paper, to see its application. So I hope this technique, this strategy will give you the overview and quickly your knowledge will be tested through the past papers. So we are done with participation approaches. It's time for section A, OTs. So let's start. Okay, the first, which of the following is an advantage of non-participative budgeting? Now, what is non-participative budgeting? We know that it's the imposed budgets, okay, as compared to participative budgeting. So, which of the following is an advantage of imposed budgeting? So, the options are, come on, I need your answers quickly. Everybody has to write the answer. It increases motivation. It is less time consuming. It increases acceptance. The budgets produced are more attainable. So quickly, number one, does imposed style improves motivations? No, not at all. Number two, it is less time consuming? The answer is yes. Imposed budgeting style is less time consuming. You know why? Because strategic management is making the plans and they better know how to make the plans, so it will be less time consuming for them. The other options, it increases acceptance, not at all, because you are not taking the lower staff input, so it will not increase their acceptance. Number four, the budget produced are more attainable. I don't think so, because if you remember my example, I gave you a target of 95%, which is, to be honest, not attainable. Okay, so yeah, strategic management might set higher plans which might not be attainable for the lower management. So the correct answer is B. Second, what is the name given to a budget which has been prepared by building on a previous period's budgeted or actual figures? Come on, guys, what's your answers? Be fast, everybody. Options are incremental, flexible, zero-based, functional. So the answer is none than the other. It's incremental budget. Yes, incremental budget is the one that starts from previous period budget or actual results. Okay. Okay, so the answer is A. Answer is A, and I hope this is clear to all of you. So just write in the question and answer section your answers. Okay. Now, a very good question which is testing your complete understanding. A budget is a quantified plan of action for the forthcoming period. Budget can be prepared using a variety of different approaches. Match each of the following statements to the correct budgeting process. Number one, build in previous problems and efficiencies. Number two, recognizes different cost behavior patterns. Number three, focuses employees on avoiding wasteful expenditure. Number four, focuses on controlling the causes of cost. Number five, always extends the budget 1 year into the future. Number six, using adaptive management processes. Okay, so let's find out the connections. This is match the following question. Okay, so let's talk the first one. Builds in previous problems and inefficiencies. And the answer is incremental budget. Yeah, incremental budget. I hope this is clear. Incremental budget. Number two, recognizes different cost behavior patterns. Okay, come on, I need your answers. I'll just check your answers as well. Okay, recognizes different cost behavior patterns. So the answer is flexible budgets. Flexible budgets. So the answer is flexible budget. Yeah, because flexible budget is a one that is prepared at number of different activity levels. Okay, number of different activity levels, and it recognizes different cost behavior patterns like variable cost, like fixed cost. Okay, third, focuses employees on avoiding wasteful expenditure. Wasteful expenditure, which is the one? It's none than the other, zero-based budgets, because it starts from a base of zero in which everything needs to be justified right from the scratch. Focuses on controlling the causes of cost. Causes of cost. Now, which is this one? It's none than the other, activity-based budgets, because activity-based budget focuses on the causes of the cost, like ABC costing. And as I mentioned yesterday, once we will cover up activity-based costing, I will give you a good recap as to what is activity-based budget. Number five, always extend the budget 1 year into the future. Yes, my friends, what is the answer, everybody? So the answer is rolling budgets. Exactly. This is what I need from you people. A very high level of interaction. Okay. Last, uses adaptive management processes, and the answer is beyond budgeting. So if you are not sure what beyond budgeting is, yesterday on the WhatsApp group, I did share the link of beyond budgeting. The concept was covered in March 2020 webinar that I conducted. So I did share the link yesterday and gave you the opportunity to revise beyond budgeting or get to know what beyond budgeting is. So if you haven't yet seen that video, do watch that video. I have shared the link of that in the WhatsApp group so that you can quickly watch the video. Now, so this is sixth one, beyond budgeting. I hope the answers are clear to all of you. Okay. Now, Sumaya Imam, you are not in the group. I did mention today. This is my number at below. You can see. Just send me a quick WhatsApp. And if you're not part of the group, I will share the group link. Okay, I will share the group link. So done with this one as well. Let's move on to the next one. X company uses rolling budgeting, updating its budget on a quarterly basis. After carrying out the last quarter's update to the cash budget update, okay? After carrying out the last quarter's update to the cash budget, it projected a forecast cash deficit of 400,000 at the end of the year. Consequently, the planned purchase of new capital equipment has been postponed. So now what they are doing is that they made a cash budget, and they saw that in the coming months or year there is a deficit of cash, which means they won't have cash. Okay, they are just doing an estimation, because if you know what cash budget is, so a cash budget is a one in which you forecast the cash surplus or the deficit in the coming month, quarter, or the period. So the cash budget is showing that in future they will have a cash deficit. Which of the following control is sales manager action an example of? Okay, so when they saw a deficit in their cash budget, so after that they quickly decided not to go for the expansion or purchase of the equipment. So this is what is it: feed forward control? Is it negative feedback control? Is it positive feedback control? Or it is double loop feedback control? So the answer is feed forward control. This is feed forward control. Now, what exactly is a feed forward control? So it's very simple to understand. You estimate things into the future, and if you see that in coming future there will something be adverse, there will be something adverse, so you take the corrective action today in order to avoid that adverse. Another example of feed forward control is target costing. In target costing, exactly we do the same thing. You remember, we find out the market price, we calculate the desired profit, we work out the target cost, and then we compare the target cost with the current estimated cost, and we find out the cost gap. All these things are done before the production has started, which means before we started making anything, we have identified the cost gap, and we try to eliminate the cost gap, we try to reduce the cost, we try to bring current estimated cost close to target cost, and all these things are done before the production, which means it's feed forward control. So what is feed forward control? Before something happens in the future, you control that thing before that happens adversely. A quick last example. Today is I think 17th of November, and you have your exam on 9th of December 2020, and most probably you'll be getting result in January, I think maybe 16th or 17th of January. So today, standing on 17th of November, you are estimating that, keeping in mind your today's preparation, your result on 17th of January will not be a good one. It's your estimation. It's your estimation. It will not be a good one. So now you got afraid, and now you just change your plan of studies and you made a very good thorough plan. And the first step was you took the webinar. And now from this webinar, you started following my $1 million plan. And you, once you start a following $1 million plan, and you get all the support, and you have made a strategy today in order to avoid the adverse result on 17th of January. So today, what all you are doing, or you have started doing, have made the strategy in order to ensure that you get the positive result on 17th of January 2021. So all those measures that you took today are known as feed forward control, are known as feed forward control. So I hope my example have made this easy for you to understand, right? Great. Now, a quick one. What is double loop feedback control? We have a question here from Asadullah. Double loop feedback control means that we compare the budget with the actual result and we get the variance. You compare budget with actual and you get the variance. Now, after getting the variance, what you do, you make a plan to improve your actual performance as well, and also you revise your budget just in case if the variance is adverse one. So you will make a strategy to improve your actual performance, as well as you will revise your budget to make that more realistic one. You will make your budget more realistic one. So in double loop, what we do, we make changes both in our actual strategy to improve our actual performance, and also we change our budget or plan to make it more realistic. Okay, so I hope this is clear to all of you. So having done with OTs that I gave you yesterday as a homework, so I think it's clear to all of you. Now a quick one, learning curves. Okay, Aisha, you are asking me about single loop. So it's very simple. In single loop, Aisha, we don't change our budgets. It's the actual performance that we try to control, but we don't touch our budgets. We keep them as it is. They were in from the day one. Okay, so that is single loop. So in double loop, we change budget as well, whereas in single loop, we don't change budget. Thank you. Now, learning curves. First of all, a quick concept of learning curve. Learning curve is applicable on labor. Listen, I'll just give you a quick recap here, and then we will all use learning curve through a past paper question. So I will not go into that details. I will just give you a brief idea, and then we'll move towards the past paper and we'll look how we need to work out that. Learning curve can come in your examination. It's very hot cake for the examiner. So for detailed understanding of learning curve, I will even share the link of my previous webinars where I've conducted learning curve in a very detailed way. If you are not good in learning curve, you can watch those videos of mine where you can get a very basic idea about learning curve right from the scratch. So it will give you a very good insight. But if you are good in learning curve, no issues at all. You can quickly understand when I will solve the past paper. So in learning curve, the concept is when you produce the product for the first time, so the time that the labor will take will be the highest one. When you produce the product for the first time, the time that labor will take will be highest one. But due to repetition of the job, and you're repeating the job again and again and again, so it will reduce your time. Why? Because you will learn new techniques, because it will improve your efficiency, because of the experience, and because of the learning that you are getting. Your time gradually goes down, down, and down. But there will be a time where your learning will stop, where you will become an expert. You don't need to further learn it. So that is the point where your learning will stop and your time will become constant. Your time will become constant. So I think this graph really gives you a good idea that this is the time of your first unit, and gradually it is coming down, 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 and it became constant. Okay, so this is learning curve. As learning curve relates to labor, so it is really important to consider calculation of learning curve. Okay. Now, as far the calculations are concerned, there are two approaches that we can use in learning curve. One is the double approach, and second is the log approach. My friends, double approach is something which is not very common. It has certain major drawbacks and limitations. So, double approach is normally used when in paper you are required to find out the learning curve. So a quick idea I'm giving you, if in the examination you're required to find out the learning rate, okay? So you have double approach which you can use. Otherwise, in all the normal circumstances, we'll be using log approach, and this log approach is what? You can see the formula y is equals to ax to the power b, okay? So through this log approach, we will find out, we'll do the calculation of learning curve, and this will make our calculation pretty much easier. And today, I will be using this log approach when I will solve a past paper question to give you the idea how can we use log approach. But remember, double approach is good when you are required to find out the learning rate. Otherwise, it's all log approach. As I mentioned earlier, if you need to get a very good understanding of both the methods that I just showed you here, so I have conducted a really detailed webinar on this topic and covered both double approach and log approach in a very simple, easy to style understand method. So you can check my previous webinars, and I will share the link of that today after the session. So if you're part of my WhatsApp group, I will share the link of that, and you can quickly just open the video and just look at that video, and it will give you a really good idea as in a detailed way as to how we work out the learning rate using double approach and how we use log approach, especially in spreadsheet. In March 2020 attempt, I did solve a question, my company, where I did show how to solve log approach using spreadsheet. So you have to watch that video as well. I'll share the link after the session on the WhatsApp groups. Okay, so now coming towards the other aspects, limitations. So let's quickly brush through the limitations. Labor intensive environment. Yeah, learning curve limitations include that it is only useful in case of labor intensive environment, which is correct because it is just labor focused. So when there are more labor, when there is labor intensive environment, then you have the opportunity to learn more and more and more, and it gives you the confidence and the experience. Okay, so it is useful in labor intensive environment, but just in case if it is a machine intensive environment, you can't use learning curve. Another big condition is stable conditions. So if conditions are stable, conditions are similar, and there are not many changes in the manufacturing condition or the environment, this means you get a really good opportunity to learn the things. The more things repeat in a similar way, the more you get the opportunity to learn and your time goes down. So it requires stable conditions. Then work should be repetitive. Obviously, if it is not repetitive, so learning curve will not exist for sure. And labor turnover should be low is another condition, because if labor keeps on leaving the organization on a regular basis, again and again they are leaving, so they will not get the opportunity to learn, right? So this means they need to be with the organization in long run. The lower the labor turnover, the lower they are with the organization, the higher they have chance to learn. Okay, so labor turnover should be low. This is a very important condition. So these are the limitations. If these are present, then learning curve is effective. Now coming towards a very important thing, and that is budget affected by learning curves. So today might be, we'll be doing a question where you will see this point. Okay, let me take one question from Asadullah here. He is saying, sir, please repeat. Intensive environment means labor focused environment is labor intensive, which means a manufacturing environment where there are more laborers working and no machine. Okay, then we have another question from one of the students who is asking, can you explain labor turnover? Labor turnover is low means less number of people are leaving the organization. Okay, so the more they are with the organization, the less they leave the organization, the more they have the chance to learn, and the rate goes down or the time goes down. Okay, stable conditions, I said that if conditions are stable, not changing very much, if you are not making very much changes in your manufacturing system, maybe you're making a food item, so the recipe is same every time. So if the recipe is same every time, so you have to follow the same recipe again and again and again, which means it gives you the opportunity to repeat and learn. But if you change sudden changes in recipe, if you do sudden recipe changes, then you need to change your entire work practice, and it will not give you a good chance to learn and reduce the time. Okay. Yeah, you can say here, Saifullah, constant rate of learning is one of the limitations, but in practical questions, sometimes there is a case where learning rate does changes. So we have to consider this in calculation. Okay. The chapter number which learning curve includes its budgets. Okay, budgets, or I would say quantitative analysis. Rubab, these are tested in OTs as well as in long questions. So today we will be doing a question you will get to understand. And if you watched my previous webinar videos, so I have solved learning curve in section C. Okay. Now coming back to budgets affected, a very crucial and an important thing here. Because learning curve relates to labor, and labor means that if there is a change in the hours of the labor, so obviously labor budget is the first one that gets affected by learning curve, because if the labor hours changes, so obviously the labor budget gets affected. The other budget gets affected by a learning curve is production budget, and this is when overheads are absorbed on the basis of labor hours. So when overheads are absorbed on the basis of labor hours, a change in labor hour will change the overheads as well. So my friends, you need to keep this in your mind. If overheads are absorbed on the basis of labor hours, a change in labor hours due to learning curve will change the overheads as well. Okay. Now, how the production budget gets affected by learning curve. This is interesting. Okay. So if labor, if there is learning curve impact present, which means labor time is gradually coming down, it is getting less and less and less due to learning effect, which means now the labor is taking less time to produce a unit. So you can understand, if the labor is taking less time to produce each and every unit that he's making additional, which means labor will be able to produce more number of units. The lower the time is getting per unit, you will be making more number of units. And if you make more number of units, obviously your production budget, which is basically budgeting of the production units, will be affected. Okay, so yeah, your production budget will be affected. Now, if your production budget gets affected, it will have an impact on material usage budget as well, because usage budget includes raw material usage. So if units are changing, the production units are changing, so the consumption of raw material will also change, and yes, it will have an impact on material usage budgets. Okay, material usage budgets. Now, if your material usage budget gets affected, which means your material purchase budget will also be affected. Why? Because if units are increasing, okay, labor is making them faster, so the overall production is increasing, which requires more usage of material, and which means you need to buy more material as well from the market. Yeah, very true. You need to buy more material from the market. This means your material purchase budget gets affected as well. Okay, so material purchase budget gets affected. You can see huge impact of learning curve. Okay, so let me quickly repeat. We have a question here: production budget, how it gets affected. So I did make this very clear that if labor is making units more faster and faster, and the time is going down, so he's able to make more number of units, and if you make more number of units, your production planning will be changed. Okay, keeping in mind learning curve, if there is a learning curve impact present, so you have to change your production budget as more number of units will be produced, which will require more material in usage, which will also have an impact on material planning of purchase, which is purchase budget. Okay, the last eventual impact goes towards cash budget. Cash budget, yes, cash budget. Obviously, everything is connected with cash. You make payment to the labor, cash gets affected. You buy material, cash gets affected. So if the other budgets are getting affected, like labor, like material, so obviously there will be impact on cash budget as well. If you produce more number of units, you need to make payment to the labor for that, and you need to purchase material for that, so cash budget gets affected obviously. Okay, so these are the impact of learning curve on different budgets. Be prepared when we are at the question, you need to figure out the answers. The last question we have: how it is affected by labor budget. Hasibur Rahman, I made this really clear initially that if overheads are absorbed on the basis of labor hours, a change in labor hours due to learning curve will bring a change in overhead budget as well. Okay, so yeah, here we go. Done with learning curve. Okay, now let's move towards the next area, but before that, here you need to see that detailed learning curve explanation will be given to you in $1,000,000 plan at the end of the session. So if you are with me till the end of the session, you will find the links of the videos which will help you to further practice the basic concepts of learning curve. Okay. Okay, so right now, what I've explained you here is the budgets that are affected by learning curve. Okay, budgets. And if these are affected, so obviously the cost will also be affected, like production cost will be affected by this, material usage cost will be affected by this, labor cost will be affected by this. So these are the effects that are considered right now, because if budget gets affected, so respective cost will be affected as well. So guys, is the link clear to all of you? A quick yes from everybody. Is everything going good? Yeah, okay, awesome. Now, a quick recap of a spreadsheet. I'm covering all those aspects relating to which we'll be doing a question. Okay, that's why I'm opening all those things, giving you a quick one so that before we move towards a question, we're able to repeat the things. Spreadsheet, a quick one. I will not take very much time on this because we are using spreadsheet in our exam as well. 20-mark question includes the usage of a spreadsheet, so you should know much more about spreadsheet. So I'll quickly move towards the advantages of this spreadsheet, what advantage spreadsheets can provide to an organization. So my friends, listen very carefully here. Spreadsheet, Microsoft Excel, I can give you an example of that. So Microsoft Excel, if you have used Excel, you have seen its benefits. For your examination as well, you are using the spreadsheet in the paper as well. So what benefits does it provide? It simplifies, saves time. Yes, it does. Different budget options can be prepared using spreadsheets. Yeah. Why? Because of the usage of formulas. I'm sure all of the performance management students know how to use the formulas. Today I will be using the formulas. So if you know the formulas, you can prepare different budget options. For example, if you have made one budget based on 100 units and you can quickly prepare a budget based on 200 units, if you have inputted the right formulas, you just have to change the number of units, and once you change the number of units, then obviously your figures will change. Formula means in spreadsheet we use different formulas of sum function, of subtraction, multiplication, division. Okay, so this is known as formulas. So today I will be doing that as well, and you will see the benefit how quickly things will change. Okay, so you can prepare different budget options. Then you can perform sensitivity analysis as well using spreadsheets. All right, what are the drawbacks? What are the drawbacks? Now, drawbacks includes number one, error can be made. Yeah, in a spreadsheet, you can simply do an error, or maybe a wrong formula inputted, a wrong figure you have used. So yeah, error can be made. Number two, over dependent risk. Exactly. If you are a good user of a spreadsheet, you really trust spreadsheet a lot. You are too much dependent upon spreadsheet. Okay. Third, qualitative factors. Factors which are qualitative, which you can't measure. So those are the factors which you cannot consider using a spreadsheet. In short, a computer never understands our feeling. Qualitative factors will not be considered by a computer. Okay. Security issues are present there. Someone might hack your spreadsheet, someone might change your spreadsheet. So security issues do exist in a spreadsheet. And it's very easy to corrupt a model. Now, what a model is, for example, if you've done a calculation using a spreadsheet, if you have prepared a budget using a spreadsheet, so it will be very easy. If security is not good, someone can easily corrupt a model, someone can easily change all the formulas in your model, and the figures will be different. So yeah, it's easy to corrupt a model, just to change the things, just to change the formulas. So this is the security concern of spreadsheets. Okay, so positives and the negatives of spreadsheets are clear. Over dependent risk means that we are very much dependent on computers, right? If spreadsheet is doing the calculation, so what you think? You would say, okay, the calculation done by the computer is perfect. Okay, calculation done by the computer is perfect. That is over dependent risk. But maybe there is a possibility that you have inputted a wrong formula and you are not aware of that, and you are getting the wrong answers. Okay. People are asking me about sensitivity analysis. Sensitivity analysis is basically a technique which will be covered in risk and uncertainty. There's a topic in your F5 syllabus, risk and uncertainty. Sensitivity analysis is a technique that indicates the most critical variable. Okay, so this is a technique that is part of risk and uncertainty. So through spreadsheets, we are able to perform this technique. Qualitative factors, let me repeat qualitative factors for you. As I mentioned that computers cannot consider qualitative factors. For example, climate changes, for example, political pressures. Okay, so these are the things that computer cannot consider. Maybe I would say the impact of pandemic. Okay, the impact of pandemic will not be considered by a spreadsheet. So spreadsheet will only function based on numbers, that is quantitative numbers, but it does not consider qualitative things. Okay, so I hope this is clear. And a quick idea of spreadsheet have been given to you. Now we are moving towards variances. As I mentioned that what my plan is, whatever questions we'll be doing, I am giving you recap of those respective areas so that when I solve those questions today, in today's class, you're able to give me the answers. Okay, so this is my plan. So all set for variances, guys. Up till now, everything is going good. Say yes or no. A quick reply. Happy? Getting the confidence? Okay, right. Now, we are starting with variances. The topic that I have chosen today is sales mix and quantity variance. And the topic that we'll cover today will be done today. The topics that will not be covered, or the question that will not be covered relating to variances, I will again do the same thing. I will give you the links of my previous webinars for those topics, and you can go to those videos and complete those areas. This is how you can complete a good amount of the syllabus by viewing previous webinars, topics, and past papers, and taking the current webinar. Okay. So today we'll be focusing on sales mix and quantity variance. A quick idea before I start the past paper. In 5 minutes, I will start the past paper. Sales volume variance. I'm sure people know what volume variance is, right? Sales volume variance. Once we break sales volume variance, so the first portion is sales mix and second portion is sales quantity. So actually, sales volume variance is further broken down into sales mix and quantity. So how we used to calculate sales volume variance? A quick recap. What we used to do is we used to use actual sales and we should deduct budgeted sales from the actual sales, and we used to multiply this with standard profit or contribution per unit. Okay, and like this we used to work out sales volume variance. So my friends, what volume variance used to indicate? It used to tell you that the units that you have sold are those more than your budgeted or not. Your actual sales is more than your budget or not. This is indicated by sales volume variance. So we bifurcate this into mix and quantity. But remember, for OTs, you will only bifurcate these into mix and quantity if these two conditions are present. Number one, more than one product is sold, which means you are a company that doesn't sell just one product, which means you sell tea, you sell green tea, okay, you sell coffee. So you are a company that deals with multiple products. Okay, so the first condition is you sell more than one product. Second, the products are interchangeable. Now it's very important to understand interchangeable. What is interchangeable? Interchangeable means that if you sold one product less, so that will be compensated by selling other product more. Interchangeable, selling one lesser product and in return selling the other product in the higher proportion. For example, you sell tea and you also sell green tea. Okay, so suddenly what happened? People become health conscious. People are now health conscious. So what happened? People who used to drink tea, they shifted themselves towards green tea. So what happened? The sales of green tea increased. The sales of green tea increased, whereas the sales of tea went down. Okay, the sales of tea went down. So this is interchangeable. When the sales of one product increases and having an exact reverse impact on the other product. As I give you the example, which is very easy to understand, and the example is the sales of green tea increase as people become health conscious, having an adverse impact on the sales of tea. So interchangeable means that if the sales of one product goes down, that will be compensated by the increase in sales of the other product. Okay, so this is interchangeable. So my friends, remember, if both the conditions are present, company selling more than one product and those are interchangeable, then we bifurcate volume into mix and quantity. We will discuss what mix is and what quantity is with the past paper question. So quickly, let's move towards sales mix variance. The formula is actual sales in actual mix, actual sales in standard mix, quantity variance. I can just change this and write it sales, quantity variance, standard profit, and profit variance. Okay, profit variance. It could be contribution as well. Okay, so actual sales in actual mix, actual sales in, yeah, it's a small mistake here, in standard mix. Yeah, actual sales in standard mix. Then you have quantity variance. You can even call this as unit variance. Okay, standard rate. We can say it as standard profit or contribution. Okay, and the profit variance. So this is sales mix variance, and through this we'll work out sales mix variance, and we'll work out sales quantity variance. So I've made the changes here, but once I will move toward the spreadsheet, I will write the exact formula there as well, so no issue for that. So sales mix is what we are calculating, and sales quantity. Let's move towards a latest attempt question, and that question is waiting for us. It's March July hybrid past paper question that we are solving right now, and very good question, to be honest. The way theory was tested, it was really good. Okay, so I've picked up a really latest question. I'm sure standing here in November, there might be students who have given attempt in March. Anyone who gave paper in March or July? Yeah, anyone who gave paper in March or July? So this was the exam that included the question on variances. Okay, okay, so guys, are we ready? Are we ready, everybody? Say yes. So I already mentioned about the break. I will give break after 30 minutes. Okay, okay. I will share the question on the group, right? I will share today the question on the group, the latest attempt question. Okay, so guys, let's see how the question is and what it is testing, and the most important is theory that I will try to make really simple for you people. Okay, so let's start. Clear Company is an eye treatment specialist founded in 20x4, which runs 5 clinics nationwide. It is based in Zealand, a country in which 20% of the population is over 65 years old. Okay, compared to only 15% 10 years ago. So 10 years ago, the population was 15% of old people, and now it's 20%. Remember, if you need to deal with questions like these in a very right way, so my suggestion to all of you is that do read the scenario very carefully, okay, and I'll show you how I link the things today. Clear Company offers 2 eye treatment procedures: laser treatment and lens treatment. Okay, it's laser and lens. Laser treatment is less complex of 2 procedures. Okay, technology changes rapidly in this industry, and as a result, 90% of the patients now qualify for laser treatment compared to only 80% 5 years ago. So now what this means, they deal in 2 types of treatment. One is the laser treatment and second is the lens treatment. It says that laser is more easier, and we all know, right? Laser is easier. Because of the technology changes, now 90% of the patients prefer going for laser treatment, okay, compared to 80% 5 years ago. So previously people used to prefer the other one, but now they prefer laser because it's much more easier and quick as well. Okay, the remaining 10%, because 90% go for the laser treatment, so the remaining 10% of patients are only able to have lens treatment, of which there are 2 types. So now there are 2 types of lens treatment, a very good scenario, you know. Refractive lens, number 1, refractive lens exchange, number 2, implantable contact lenses, RLE, ICL. Okay, these are 2 types of what? Lens treatment. Clear Company started providing RLE, a treatment most effective for patients aged 40 years or older, in 2004 when it was founded. So basically, RLE is more useful for people who are above 40 years. Okay, so I think people who are above 40 years, and if you see here, the population in this country, Zealand, is also increasing for old people, that is more than 65 years. 2 years ago, it also began providing ICL, a treatment recommended for patients under the age of 40. Okay, so ICL is useful for those who are under 40 age. Okay, so ICL for under 40 and RCL for more than 40. RLE, sorry, RLE. The market for eye treatment procedures in Zealand is dominated by a few main suppliers, of which Clear Company is a one. Okay, so market is dominated by few competitors, few main suppliers. Until 2 years ago, Clear Company was the largest supplier. So you were the largest supplier, right? Following the merger of 2 other companies, it is now second largest. Okay, so 2 of your competitors have merged their business together. This means now they have become the market leader and you are not the market leader, okay, because of that collaboration. The merged company, named as EOS Company, has recently released its financial statement for the year, showing profits which were 10% higher than forecast. Okay, COS press release stated that it has achieved this despite offering reduced prices for ICL treatment. So this is very clear that they have reduced their prices for ICL treatment, which means a normal thing that can come in anyone's mind is if your price goes down, your quantity should increase. Okay, it's a normal perception. If price goes down, so your quantity or volume should increase. So they reduce their prices for ICL, and despite that, they are able to achieve higher profits, which means higher sales volume. Okay, it has been able to offer reduced prices because of economies of scale achieved by the merger. Okay, the following information related to two types of lens treatment offered by Clear Company, and one is RLE and second is ICL, and these two basically are used by 10% of the customers because 90% go for laser treatment. Number of treatments, budget actual, their selling prices and variable cost. Requirements number one, which came in your paper, was to calculate sales mix contribution variance, sales quantity contribution variance. So when it is contribution, so this means company is using marginal costing, and this means your answer is basically focusing on contribution. So as I mentioned earlier, we break sales volume variance into two parts. One is known as sales mix and second is known as sales quantity variance. I will be solving my answer using a spreadsheet to show you people how to use spreadsheet effectively and for your own advantage. So yes, let's start using spreadsheet. Okay. I need to take my keyboard. Okay, so now see what I'll do. I'll make this very easy, simple and clear for you people so that you are able to understand things in a very effective way. I hope you will like my strategy. It is good if you have your laptops available so you can easily work with me. If you don't have, just understand what I'm doing and later on do practice that. So part A, first it's sales mix variance. Okay, the formula is actual sales in actual mix. Okay, second is actual sales in standard mix, right? Okay, so we have two products. Let me look at the names. It's RLE and ICL. Now we have standard contribution, okay, per unit. Spreadsheet will save lot of your time. So yes, you have to use spreadsheet a lot. I think spreadsheet is a very good advantage that examiner has given us. You should be understanding these things so that you are able to, focus on saving your time. Okay. Now, sorry, this is your fourth column. Units, variance, standard contribution, and contribution variance. Yes. So here we have the formula in front of us, and these are the two products. So let's, use certain borders. It's not compulsory, but just to make it more, simple, clear to understand. So I can do that. Okay. All right. So here you have this. Now, see the magic. See the magic. First is actual sales in actual mix. Okay. So let's see what actual sales is in actual mix. So for RLE, the actual is 4130. 4130. I'll make this really easy for you, okay? For ICL, the actual is 960. 960, right? So let's add these two, right? Sum is the formula that I'm using here. These are the formulas I was talking about when we were at spreadsheet. So you can use the sum formula. Is equals to is important every time. Is equal to sum bracket open. You'll select these two. Just press the button enter and you will get a total of 5090. So this is actual sales in actual mix. Okay. Just observe actual sales in actual mix is the first column. And now look here, it says actual sales in standard mix. Actual sales in standard mix. So this means your sales should be actual one. Sales will be actual one, but your mix will be standard one. Okay, so this means we need actual sales similar, which is here 5090. So I'll write here 5090, right? This should be my actual sales, right? But this should be in a standard mix. So how will I able to work out standard mix? So let me tell you here. We have two products, RLE, and second is ICL. Now, if you see here, let me show you the budgeted treatments of RLE is 3750 and ICL is 1320. Okay, so 3750 and 1320. If I sum these two, I will get the total of these two, which is through the sum formula 5070. Now by this working, I will work out the standard mix. What is a standard mix? It tells you the mix that the organization has decided, or I would say the proportion of units that the organization has decided that it will sell for one product and the other product. Marketing teams do plan how many units we expect to sell for one product and how many we expect to sell for the other product. So that is known as mix. That is known as mix. I would say ratio. Okay. So let's see the ratio. Let's work out the ratio. So out of 5070, 3750 will be RLE, and this is how much? So the ratio is 0.739, which is actually 74% will be we need to sell RLE. Second one, this divided by the total, so this is 0.26%, which means around 26% we will be selling what, friends? We will be selling 26% what? We will be selling 26% of ICL, okay? So this basically that I've worked out is known as standard mix. This is standard mix. I hope you all are getting my point. It tells you the percentage or the ratio that the team or company is expecting that they will sell for a certain product. Standard mix, okay? This mix word is really common. I'm sure you all know those ready-made product that is used for making different type of food items. Okay, so you use these recipes that are given to you. So behind the boxes of spices, there are different spices that comes. You buy spices. So you've seen at the back of that spice box there is a recipe given how to cook a certain thing. Okay, how to cook a soup, how to cook a cake. So the recipe that is given to you mentions half tablespoon you have to use this, half teaspoon you have to use this. So this is what? This is your standard mix that is given to you. Okay. So here we are. Now, my friends, let's bifurcate actual sales into standard mix. So it's very easy. The sales should be actual, but mix should be of standard. So let's see how I'll do it. Is equals to actual sales multiplied by, according to a standard, RLE should be 0.739. So here we have the figure. Again, 5090 multiplied by, according to this, ICL should be 0.2603. Yes, okay, right. Now, let's use a formula where we will deduct actual sales minus actual sales in standard mix. So it's actual sales in actual mix minus actual sales in standard mix, and the difference you are getting is 365 units. A similar formula will be used, so I'll just copy paste the formula, Control C, Control V, it's 365, and you can see here one is 365 positive and other is 365 negative. So let's sum these two, and once we sum these two, we get exactly 0. So the quantity will be offsetted against each other. And yes, what is this? What is this? This is known as interchangeable, okay? Which means that 365 RLE sold more, okay? Sold more, whereas 365 ICL sold, yes, this is interchangeable. One product units sold more by 365 and the other product units sold less than 365. So this is interchangeable. As I was talking earlier, this is interchangeable and the answer is 0. So I'm sure you are looking at the presentation. Okay, you are looking at presentation. Now you tell me if you sell something more and something less. Okay, when you sell something more for sales, is it good or bad? So obviously, in case of sales, selling more units is favorable. Yes or no? Obviously, selling more units, it's favorable, right? So it's definitely favorable here, selling more number of units. Okay, so it's favorable. Now, one more thing to identify favorable and adverse. If you use my formulas, a positive answer is favorable, a negative answer is adverse if you use my formulas. So mathematically, if answers are getting positive, it's favorable. Mathematically, if answer is getting negative, that is adverse. This is mathematically, if you use my formulas. Secondly, conceptually, it's very clear that more units sold obviously is what? Favorable. Less units sold is obviously what? Adverse. So this is adverse. Less units is adverse. Anyways, clear? Less unit adverse. So 365 units sold more for RLE, whereas ICL units were sold 365 less, interchangeable. Now the contribution. So can we work out contribution? Yes, we can. Standard contribution. We have a selling price of 3,000 minus variable cost of 600. Okay. So let's use the formula. 3,000 minus 600. 2,400 contribution for RLE, whereas 3650 minus 1150. Okay, so this is the contribution answer for ICL now. Are you all with me, guys? Say yes or no. Okay, everybody understanding the format, say yes or no. Right, now let's multiply 365 multiplied by contribution, and again negative 365 multiplied by contribution, and here you have the figures of positive contribution and negative contribution. Okay, positive and negative contribution. So if I just net off these two using a sum formula, so you can see here, once I'll net off these two, so the answer we are getting is negative answer, and mathematically, if we are getting negative answer, so it is adverse, okay? Adverse. If we are getting negative answer, so it's adverse. So yeah, it's adverse. Mathematically, conceptually, I will tell you why this is adverse. Conceptually, I'll discuss why this is adverse, but mathematically, it's adverse, okay? Right. So someone asked me to show the working of contribution. Its selling price budgeted 3,000 minus 600 budgeted variable cost. That gave you contribution of 2,400. So in the question, you had these figures available. Okay, friends. Okay, I will share the spreadsheet answer. How's that? If I share the spreadsheet answer. Conan Mustafa, would that be okay? Okay, so done. Now, if you remember the formulas right, see how easy I will make the other variants for you. Do give me the feedback by looking at the magic. So let's start my magic. Let's select these all. Control C. I'll write here sales quantity variance. Okay, there we go. And I'll paste here whatever I've copied from above. So here I am. Okay. Now, what I'll do is that I will make the necessary change. I will make the necessary change. Okay. What I've done is I've just copy pasted this. That's it. Now, if you remember the formula, so you can easily work out the answer without any hesitation and without wasting a lot of time. So what is the formula of sales quantity variance? The formula is actual sales, I'm writing in front of you again, actual sales in standard mix. Okay. So the formula is actual sales standard mix. I hope you all can see here what I am doing. Actual sales in standard mix is the formula, right? Okay. Second is standard sales. You can even copy from here. Standard sales in standard mix. All right. Standard sales in standard mix. Okay. Standard sales in standard mix. Now, how can I make this easy for me? The rest three remains the same. Okay. How can I make easy? Hasnan, copying is very simple. Control C and Control V. That's it. Okay, it's very simple. I just copied the above table and just pasted here. That's it. Like this. Control C, copied, and have just pasted here. Nothing else. Okay. Okay. So now, just observe the second column of mixed variance. This one, second column of mixed variance. Okay, is similar to the first column of quantity variance. Is that so? Is that so? Yeah, it is. The second column of mixed variance is similar to the first column of quantity variance. So why are we wasting time? Can we copy these figures? Yes, we can. So is equals to, and here you go. Is equals to, and here you go. Easiest as ever. Easiest as ever. Okay. Easiest as ever, right? So simple. The second column of mix is same as the first column of quantity. Copy paste. Now, what about the second one? And I'll get the answer. See, because all the formulas are already there. I just copy pasted the mix working towards the quantity. So formulas are present there. Okay. So now, standard sales 3750 and 1320. So it's the budgeted sales I have to take here. Yes. 3750, 1320, and that's it. This is my answer. This is my answer. Nothing more I had to do here. I just used the figures using the spreadsheet. You can see the magic. And if you follow Rizwan Mania's formula, so if you're getting a positive answer, it's favorable. If you're getting a negative answer, it's adverse. So mathematically, you can determine very easily. If you don't know the concepts, use mathematics concept here. But I will also tell you the concept here. But right now, I can easily write that this is favorable. Okay, this is favorable by 48520, and here we have the answer of both the variances in a very easy to learn manner, and here you have the answer of both in front of your screens. Okay, so guys, what's your feedback? Happy? What is your feedback? Understood? Did I make this easy? Yeah, I just had to change the sum formula here. Sorry, that I had to change. You're right. That is 5070. Yeah. Okay. Examiner can see in the formula bar, so you don't have to show separate workings. Okay. I've changed the total here. I have changed the total. I just had to use the formula of sum here. So I've changed that. Okay. Copy paste is simple. I'm telling you, it's not difficult. You just select this, Control C, and you come here and paste Control V. That's it. This is copy paste. Boss, it says mixed variance. So what you can say about kgs losses and what is this? It's not material mix and yield variance right now. Not now, you don't need for that. There's no need as such. If you want to round off, that's okay. I'll just show you that as well. But no need as such. Okay, Akbar? Okay. So guys, happy? Now, if you want to show things more structured wise, using commas and brackets and negative things and rounding off, so I will tell you a very quickest method available on ACCA portal. So see what the method is. You select all these numbers like this, okay? Select all these numbers like this, and there is an option available. I'm going here. Just watch the option. Here I am, and select which one. So I'm counting 1, 2, 3, 4, 5, 6, 7, 8, 9, 10th. The 10th option, okay? The 10th. Just click this and see, wow, everything structured accordingly. Brackets, negative signs with brackets, commas, rounded off, right? So let me do a quick hustle again. So let's go here, select the numbers, click this one. Which option? Come on, tell me, which option? 10th or 8th or 7th? It's the 10th option, yes. And here we are, the 10th option, and you can see things are clearly formatted very easily, the 10th option. Okay? So guys, what's your feedback up till now? Useful? Easy? Is the method clear? For that you should know the formulas, okay? So I expect just few days are left, you know the formula. This is not necessary, okay? This is not necessary. This is just to show a good presentation. If you don't have time, so no issues, right? Okay, that I'll explain. That I'll explain. That I'll explain. Okay. Standard film and standard mix is the most easiest thing one can do. Most easiest thing. 37501320 is available in the question. Budgeted information. It's the most easiest thing, okay? Yeah. So now it's time for break. Please, if you're new to this session, send me a WhatsApp message at my number so that I can share the new group link. And today I will be giving you the plan as well as the slides in the past paper using the group. So just send me a WhatsApp message. Let's take a 10-minute break as planned. So see you after the break. Thank you. Okay, welcome back. So now, today I'll take class, 7 we have in the official time, so I'll end around 7:05 or 7:10, okay? So I hope 10-15 minutes won't harm you. Ready, guys? Okay, so everybody can hear me? A quick confirmation. Yes, please. A quick confirmation. Can you all hear me? Hello? Okay, is the sound clear to all of you? Okay. So are we ready, guys, to start? Are we ready, everybody? Okay. Now comes the interesting part where I will be covering theory. I explain you the reason for the variances, and yes, I will also tell you how to draft the theory in a very easiest method, okay? So please be with me till the end of the session. And today we will be doing planning and operational as well. That too I will be solving on a spreadsheet. Then a very good question as well later on. So yeah, please be with me till the end. Let's start now. Now, the first variance is sales mix variance. So please listen very carefully, because if you're not listening carefully and if you ask me again, I've explained you that, so that will waste our time, everybody's time, okay? So please just be active and listen very carefully what I'm saying. Now let's start with actual sales and actual mix. First, I'm starting with sales mix variance, and I have here the reason for variances as well. So I'll be using both and will explain you. Sales mix variance basically is a variance that indicates the difference between actual sales mix and standard mix. Okay, just look at the formula very carefully. See here, actual sales, I'm highlighting in front of you, actual sales and actual mix compared with actual sales in standard mix. Okay, so if you just find out the common between these two things, can you find out the common word between these two? Anyone can tell me very quickly, please? Any common word between these two sentences? So yes, the common is actual sales. Okay, it's the actual sales. So see, because actual sales is common, that is why you can see 5090 here as well as 5090 here. Okay, so because the sales has to be common and same, so the total sales figure is same. Okay, it's the actual. Now can you tell me the difference between those two statements? What is the differentiating thing between the two statements? What is this? Actual sales in actual mix, actual sales in standard mix. What is the differentiating point? Can you tell me, guys? Be fast, everybody. So yes, the difference is actual mix versus standard mix. Yes, exactly. Actual mix versus standard mix. So remember, sales mix variance is a difference between actual mix and standard mix. Okay, so it's mix versus mix. The mix, the ratio that you have planned that you will sell those products in using that, and actual that you have sold in the market. So it's mix versus mix, whereas the actual sales remains the same. Okay, so friends, listen, the bottom line is same. That is why you are getting zero answer in quantity or unit variance. You are getting zero answer in unit variance, right? Because 365 units of RLE sold more and 365 units of ICL sold less. Okay, so this is the difference in mix, known as mixed variance. So what we have planned was we needed to solve 4130 units of RLE, but we were able to sell 3765. So we have sold more units of that, so it's favorable. Okay, now second one, we have to sell 960 units of ICL, sorry, we sold 960 units of ICL, whereas we had to sell 1325 of ICL. So we sold less ICL. So this is adverse. Now, see what it says. The answer is adverse. Let's go to the reason for variance. It says that when sales mix is adverse, what it means? When more profitable product is sold less profitable product is sold more. So this is the reason. Okay, so let's have a look here. Is it that more profitable sold less and less profitable sold more? So let's find out between these two which is more profitable, guys. So yes, which is more profitable? Let's have a look here. Now, RLE 2400 contribution, ICL 2500 contribution. So it's very clear that RLE is less profitable, less, okay? It's low profitable, I would say. Low profitable is RLE, and what do you think? Sold more or less? So it says low profitable is RLE, right? And it has been sold more, okay? So low profitable RLE has been sold more because it's positive answer, okay? Now, what about ICL? ICL is high profitable, okay? High profitable sold less, right? High profitable is ICL and sold less. Now you decide, my friends, you are very good enough to decide, right? So when low profitable sold more, it will give you profit, a favorable profit of 876,495, and by selling less units of ICL, you were not able to earn profit according to budget. So this is an adverse figure of 913018. So by this amount, your profit has gone down. This is not a loss, okay? People think this is a loss. That's wrong. By this amount of 913018, your profit went down than expectation, okay? So 876 is more profit than expectation, and 913 less profit than expectation. So eventually less profit than expectation because the product ICL, which was more profitable, you sold less of that, whereas product RLE, which is less profitable, you sold more of that. Okay, so remember, adverse variance is when more profitable product sold less and less profitable product sold more. Okay, clear, guys? So I hope this is clear to all of you. Okay, now vice versa of this is what? Favorable. So when this is favorable, the situation is vice versa. So what is vice versa? Come on, tell me, friends. When more profitable product is sold more, yes, and less profitable product is sold less. So it's vice versa, okay? When it's favorable, it's vice versa. So are you clear about the reason, guys? Say yes or no. So in our case, ICL is more contribution one, but we sold less. Whereas in our case, RLE is less contribution product but sold more. Exactly. So it's the mix variance which indicates the difference between actual mix and standard mix. Okay. And that is why the quantity will always be zero. Reason is the both figures of actual sales are same here. Now comes quantity variance. Very quickly, before we move towards the theory, very quickly. So guys, be ready with me very quickly. Sales quantity variance. Here we are. Actual sales in standard mix. Actual sales in actual. Okay. Actual sales in standard mix and standard sales in standard mix. Come on, can you tell me the common thing between both? Tell me quickly the common thing between both. Be fast. The common is standard mix. So my friends, remember, when there is a common thing when there is something common in both the things, so that is not comparable, because in both your standard mix and standard mix. Okay. Okay, so what is the uncommon thing? Anything which is uncommon is basically a one that we compare. So the uncommon is actual sales, yes, versus standard sales, yes. So it's a fight between actual sales and standard sales. Okay, so now the variance that you have right now has nothing to do with mix, because mix in both the columns is same. So just go to the bottom line here. Let's see the bottom line. Okay, actual sales, we had to sell 5090. Okay, we had to sell 5090. Is that right? 5090. But sorry, I beg your pardon, how much we sold? How much we sold? 5090. Okay, and how much we had to sell? 5070. Just look at the final bottom quantities. Okay, are the bottom quantities different, my friends? Come on, say yes. Yes. So we sold 5090, whereas we were required to sell 5070. So both the products, whether it's RLE or it's ICL, both have been sold more in terms of quantity compared to the standard. Right? So yeah, 15 more units sold for RLE than the standard, and 5 more units sold for ICL than the standard. I hope you are getting what I'm saying here, right? So look at the bottom figures. So the actual sales is more and the standard sales is less. If you have sold more units in total, how many units you have sold more? 20. Okay. So if you have sold more units, so this means that you have a favorable variance. You have sold more quantity. So quantity variance basically has nothing to do with mix. Okay, it just deals with actual quantity and standard quantity that you have to sell. So more quantity sold. Okay, so the answer is 20 and it's favorable. More quantity sold. So if you have sold more quantity, more contribution of profit. The last question that I just saw here was, why are we not getting here 0 in quantity? Because just look at the bottom figures. The quantities are different. I just want to highlight this for you. Okay, see, the bottom figures are different. But look here, in mixed variance, the bottom figures are same. So that is why here the unit difference will be 0, because sales is actual in both the cases. But here, because the bottom figures are different, the quantity is different. So you are getting the difference of 20 here. So it's quantity variance which compares actual quantity with planned quantity. Now, if you're sold more, it's favorable. Let's go to the reasons why it will be favorable. So there are different reasons. Number one, A decrease in price can increase the quantity, right? Exactly. Decrease in price will increase the quantity. Law of demand. Second, favorable market condition. The market conditions are favorable. That is why it's a good market. So yeah, that is why. Third, good quality product. Good quality product resulted in more sales and the quantity. Okay, so this is favorable here, and the reasons are clear. Okay, now, so if quantity is favorable, more units sold compared to what we have. So these are the possible reasons. What will be the adverse? So it's vice versa. If your sales quantity is adverse, what could be the reasons, friends? Maybe increase in price, resulted in lower quantity, adverse market conditions, maybe poor quality product because of bad quality, the volume has gone down. Okay, so yes, here we are. Okay, so I hope the basic reasons are clear. Why sales mix is adverse, why sales mix is favorable, why sales quantity is adverse, why sales quantity is favorable. These are the general textbook points. So you need to keep these textbook points in your mind. And now let's do the magic. So magic is coming here, and that is your theory. Okay, so let's move to the question again, and let's touch the theoretical areas. First of all, part B, explain is the verb. You remember the way I just taught you how to break the requirement. Explain is the verb. What each of the sales mix and quantity variance measures. This is for 2 marks. It's very simple, straightforward, with no problems at all. So what you are supposed to do, explain what is the object, sales mix and quantity. So you just have to write the basic definitions, okay? The basic definition. Now it is knowledge based or application based. Come on, my experts tell me. You are all experts now after yesterday's session. So it's knowledge based. Okay, so let's have a look what we need to write. Basic definition. Sales mix contribution measures the effect on contribution by changing the mix of actual sales from budgeted sales mix. Okay, now quantity. The sales quantity contribution variance measures the effect on contribution of selling a different total quantity from budgeted total quantity. So quantity variance is basically quantity difference, and mix basically is mix difference, and these two, when you combine them, they become sales volume variance. Okay, so simple definition you have to write. Now coming back to the other question requirement. Wow, it's a 10-mark requirement. Can you imagine? 10-mark requirement. Come on, my experts, tell me one thing. Using your answer from part A and other relevant calculations, okay? Just determine the object. Discuss sales performance for the year just ended. 10 marks, okay? There are 4 marks available for additional calculation relevant to sales performance and 6 marks for discussion. Okay, you are getting more marks for calculation here. Come on, my experts, tell me, are you all with me? Say yes or no. So what is the object? So let me write here. The verb is discuss. Okay, verb is discuss. Okay, what is the object? The object is sales performance. Okay, but in this sales performance you can do additional calculations as well. Okay, so additional calculations as well. Right, great. So verb is discuss, object is sales performance, doing additional calculations, we will get 4 marks for that. Now, is it knowledge based or application based? Friends, tell me. So the answer is it's relating to Claire company. So yes, great, awesome. It's an application based question. Apply the knowledge. Okay. Now, very quickly, let's see what spontaneous answer you give. What additional calculations are possible here? Come on, tell me the basic additional calculations for sales performance assessment? Can anyone tell me quickly? Okay, 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 okay. Now, let's make this seriously very easy for you. Come on, tell me. Do you want to make this easier for you? Say yes or no first. Do you want to make this easier for you? Say yes or no. Do you want me to make this a piece of a cake? Okay, so you want to eat a cake, right? Let's see you want to eat a cake or not. You see. Okay, so let's make this easy for you all. Now, what I'll do simply is, see what I'm doing here. What I am doing for additional calculations. I've seen your suggestions, but what I am doing very quickly, just check. I'm calculating sales price variance. Okay, I'm calculating sales price variance. Okay, so product one is, let me check. Yeah, it's RLE and ICL. Additional calculation will give me 4 marks. Okay, so what I'm doing is I'm calculating sales price variance. So is it possible for me to do it? Yeah, it is possible. So what's the formula? We all know actual price minus standard price. So what is the actual price of RLE? Is equals to 2900 minus 3000. Okay, open the bracket. It's important. Multiplied by number of units. So how many units do we have? Actual here. Units 4130. If you are getting the answer in minus, it's negative. It's adverse. Yes, it's adverse because you sold for a lower price of 2900. Okay, now ICL is equals to, what is the actual price? Tell me please. 3400 minus, what is the standard price? 3650. Okay, and the number of units actually sold are 960. Yes, so if the answer is minus, it's adverse. Okay, right guys, it's adverse. Okay, so in both the cases the answer is adverse, which means lower price charged. Lower price charged. Okay, right. Now what other calculation can I perform here? Sales volume variance. Okay, sales volume variance is what I can work out here as well. I know I've worked out the quantity and what you say mix, but here I'm calculating volume separately for both as well. So RLE, ICL. Okay, now what's the formula? Normal volume variance we have to work out, friends. So the formula is actual sales 4130 minus standard sales 3750. I hope you can see the figures. Okay, multiplied by the contribution, and the contribution standard was how much? I've worked out that 2400. Okay, so this is the answer. This is positive. When it's positive, it's favorable. Okay, more units sold. Now in case of ICL, what is the actual units that we sold, 960. Okay? And what is the standard one? Yeah, 960 minus 1320, and the profit, the contribution was, we had worked out the contribution, it's 2500. Yeah, 960 minus 1320 multiplied by 2500. So let's use the brackets. That's why brackets are important. Here we go. So this is minus, this is adverse. Okay, so let's add the above ones. Okay, 653,000 is price variance adverse, and if I add these two, so 12,000 is volume variance favorable. These are the additional workings I'm doing here, and I will be given 4 marks for that. Okay, so volume variance is 12,000 favorable, right? A quick check with mix and quantity as well. So let's check here. Mix was and quantity. Okay, so mix is how much? Let's relate this from the above working. Yeah, and quantity is yes. Okay, so if I net off these two, mix and quantity, what should I get? Should I get volume? Yeah, here we go. We have volume. Guys, clear? So we are getting volume here. Right. Mix and quantity, right? Okay. So you know sales volume is bifurcated into mix and quantity, and I've just showed you my additional workings for which I'm getting 4 marks, selling price variance for 2 products, sales volume for 2 products, and mixed quantity. I've already done the working of that. So my mix and quantity should be equals to my volume variance. Okay. We don't have to write the formulas. Okay. We don't have to write the formulas. Just do calculation in the cell. That's it. Now it's time for magic. $1,000,000 technique to write theory. And what is that? CRIC. Okay. What is CRIC? Calculate the variances. I have done that. I worked out price, I worked out volume, and I bifurcated that into quantity and mix. Do give me a feedback if you like my final technique, okay? Right, so done with variance. Then think about the reason why price is adverse. Think about the reason. Why volume is favorable? Think about the reason. Why mix is adverse? Think about the reason. Why quantity is favorable? Think about the reason. And select. Now what select means? According to question. Yes. You can't throw the reasons. Now, you must have reasons that you have seen in your textbooks or in teacher's notes, the basic variances that you have covered in management accounting level, F2, the basic variances, okay? But you can't write those basic variances. Listen, my friends, you can't write those basic variances. You can't write those basic variances. So select means it should be scenario specific. You have to find the reasons from a scenario and then write, okay? So think about the reason, the basic F2 reasons, and link those with the scenario to select this right one, okay? Then comes interdependence. What is interdependence? means one reason making one variance favorable and other adverse. So what is interdependence? One reason is making one variance favorable and other the adverse. For example, quick one, bad quality material bought, bad quality material bought. Because of bad quality material, material usage variance is adverse. Okay? Bad quality material means more wastage. Usage adverse. But that bad quality material was cheaper to get. Was cheaper to get. And if it is cheaper to get, so yes, material price variance favorable. Material price variance favorable. So this is interdependence. One reason is making one adverse usage and one favorable. Interdependence. Okay. And then conclusion. Okay. So when you are writing theory, my friends, remember Rizwan Mania's $1 billion technique. CRIC. What it says, come on, write quickly. CRIC. What is CRIC? C for variance, R for reasons, I for interdependence, and C for conclusion. Will you remember me with quick say yes or no? Guys, come on. Let's be active. Right. So let's do this. Okay. So let me start with this now. And let's keep keyboard in place. Let's open our workspace to write and see how will I make this simple scenario based logical using trick. Okay. Okay. Now, clean company, part C. Please do copy what I'm writing here. How will you draft the theory? So you need to keep in mind trick. Okay. Calculation of variances done. Let me write here. Price variance. I'll make this really easy for you. Price variance. Just a quick check. Okay. Price variance 653. And that is adverse. Yeah. Volume variance 12,000 favorable. Now breakup of these two. So what's the breakup? Let's have a look. $413 and $240 product wise, okay? $413 adverse and $240 adverse. For volume, okay. For volume, it's 912 and 900,000. 912 and 900,000. So I think first is favorable and second is adverse, if I'm not wrong. Yeah. Okay. So here you are. Now volume has been bifurcated into two. See how I will make this easy. Volume bifurcated into two. Just check the connections. Mix 36,521. 36,521 adverse. Quantity 48,521. Quantity 48,521. It's favorable. Yeah. So the answer was 12, right? Now here It's the picture. Let's apply crick here. Let's apply crick here. So we are done with the calculations. Yes, we are done with calculations. Now reasons. Think about the reasons. It should be scenario based. Why sales price is adverse by 653,000? Why? Okay. So let's go back to the scenario, and I will change the color of my pen to make sure that you understand the reasons clearly. Okay. Why our prices have gone down? Very simple. Because of the merged company EOS, competition raised. Competition went up. Okay. So because they are now the market leader as written in the scenario. So yes, I will write here, due to competition, I had to reduce the price because of EOS company, which is the market leader. Simple, quick. Quick says, calculate the variances, then find the reasons of those. Okay, reasons. So this is the reason for price variance. Clear. Now, volume. Volume is 12,000 favorable. Okay. So why volume is favorable? Why volume is favorable? We have 12,000 favorable here, but I want to dig out this, because if you see in volume, you have favorable of 912 that pertains to RLE, whereas you saw an adverse here of 900,000 of ICL. Now this is a concern for me. ICL is adverse. RLE is favorable, okay? But because ICL is adverse, the concern is why? What's the reason for this to be adverse? Okay, so let's see here. Go back to the scenario, and you see it is written here. See, it's so easy. The competitor reduced the prices for ICL treatment. It's very clearly written. Our competitor have reduced the prices of ICL because prices of ICL has gone down by the market leader. This created pressure on our business, even though we also reduced the price of ICL, but we could not do anything because that is a market leader. So because they reduced the prices, they took a larger volume of that. We could not. They did that. Okay, so simple, because market leader reduced the price. ICL price, EOS company reduced the price of ICL, and because of that we were in pressure. Because of that we were not able to capture the big market, even though we also reduced the price here, you can see, but they took the advantage of the volume. Understood? Okay, so quick, calculate and then the reason. Okay, now let's find the reason for mix. Mix is adverse. Now why mix is adverse? So I explained to you. High profitable product sold less. This is ICL, right? Low profitable product sold more. That is RLE. Okay. Why this happened? Why? So anything given the scenario, it all depends how good you are a reader. So yes, you can see here, because population of 65-year-olds has increased by 5%. Because population of 65-year-old have increased by 5% from 15 to 20, and because because RLE is more useful for patients who are aged 40 or older, which means the demand for old people is increasing in the country because more people are getting aged, and RLE is a treatment for 40 years or older, whereas ICL is a treatment for 40 years below. Are you getting my point, my friends? So if the 65-year-old people are increasing in the country, so the demand for their treatment will increase, and that is why the mix of RLE has increased, whereas the mix of ICL has gone down because more people are now aged. Wow, excellent, excellent. Okay, so yes, you can write here the mix has shifted because 65 years old people are increasing and they require which treatment? They require RLE. That is why RLE sold more than ICL. Okay, so it's more, it has been sold more and has a lower profit. So that's why mix is adverse. Getting the point, guys? Come on. Are you able to link with me? Is it easy? Come on, tell me. Is my effort making this easier or not? Okay. Now, quick. Okay. Then comes the R. R. So, now quantity. Favorable. Why quantity favorable? Okay, so if you just recall the reasons we covered right now, quantity could be favorable because of decrease in price, good quality product, okay, and at favorable market conditions, okay. So out of these three reasons that we covered right now, which you think is the more relevant here? Come on, tell me, which is the more relevant? The quantity is favorable just because of what? So yes, you'll be able to clearly relate here, and that is decrease in price. Here we go, decrease in price. So because we decreased our quantity compared to the planned budget has gone up. Okay. So decrease in price is the reason for increase in the quantity. Are you getting the point, my friends? I just showed you the reasons behind, if you remember, and the reasons are here. See, so it says decrease in price made quantity favorable. Okay, right. Now, quick, C, R, done. I, interdependence. So what is interdependence? One reason making one adverse and other favorable. Do you find any interdependence, my friends, here? Yes, there is. See, decrease in price made sales price variance adverse, whereas it made sales quantity variance favorable. Yes, interdependence. Decrease in price made one variance adverse and the other favorable. Exactly. Okay. So one adverse, one favorable, interdependence is there. Now comes the time to conclude. So, how will we conclude? Friends, let's look at the conclusion. But is the quick methodology easy for you to understand? First, calculate the variance, then think about the reasons separately for each. And yes, from scenario, need from scenario, and then find interdependence. and then you can conclude. Okay? Now listen. Now listen. Before I move towards conclusion, should I show you how this will be presented in a paragraph? Come on, tell me. Should I show you how this will be presented in a paragraph? Okay, let's do this for you as well. Here you are. We know the verb, we know the object. Answer pointers are what? Crick, calculate, reason, interdependence, conclude. Okay? So now, let's see how to write in a paragraph form. It's a 10 mark, right? So, be with me. See how I'll start. Sales price variance overall is 653,000 adverse. This resulted due to RLE variance. Now, how much is RLE? I need to check. It's 453. Yeah, RLE is 453,000 adverse, and ICL. How much is ICL adverse? It's 240, right? Yeah. Understanding how I'm writing? 240 adverse. See, this is how to write. I've made this really easy. The major reason for reduction in price is due to severe competition. Reason, see, this is the reason. This is the reason. Because of merger between two companies. Yes. First, tell about first tell about the variance figure and then write the reason. Okay? Then write the reason. Okay, now let's move on. The sales volume variance is overall 12,000 favorable. Okay, this resulted due to RLE variance is 912,000 favorable and ICL variance is 900,000 adverse. Are you understanding how I'm writing? This is how you have to write. Keeping in mind, crick the $1,000,000 technique and just start writing. How? First, write about the figure of variance and then the reason. Figure of variance and then the reason in a paragraph form. And this is how you can draft your theory. Now, the volume variance of ICL is significantly adverse, as you can see here, due to EOS company price reduction of ICL treatment. Okay, great. For further in-depth analysis, we will break sales volume variance into sales mix and quantity variance. Are you getting the point, guys? Okay. Sales mix variance is adverse by 36,000. I'm not adding the exact figure, okay? 36,000. Now, why is that? Due to lower sales of ICL having higher contribution than RLE having lower contribution. Mixed variance. Now, what is the reason? What is the reason, guys? Tell me. The major reason for this is increase in population of old people over 65 for whom RLE is effective treatment. Awesome. Is it easy, guys? Okay. Okay, thank you very much for your feedback. Okay, so this is crick, the magic of crick. The variance calculation, then the reason. Okay. On the other hand, sales quantity variance is how much was the quantity? If I'm not wrong, it's 48,000, right? 48,000 favorable. Why? Mainly because of increase in sales, then budgeted due to reduction in price. So yes, see, this is interdependence. See, interdependence. See, are you getting my point? Interdependence. Reduction in price, increasing the quantity. Interdependence. Interdependence. This is how we write interdependence. Okay. So this point is interdependence point. Agreed, guys? Okay. Now, another factor for which it is not possible to quantify from the information provided, but which will invariably have an impact on sales of lens treatment overall is increased availability of laser treatment to customers. Now remember, this business does not only deals with lens treatment, it also deals with laser treatment. So what all we have done right now is lens treatment. RLE and CICL, both are lens treatment. Nothing is mentioned about laser treatment here. And it has mentioned that laser treatment is used by 90% of the patients now. Nothing is given about that. But this is also part of their sales. This is also part of their sales. But the only thing we can write here is that from 80 to 90% population now uses laser treatment. So this also have an impact, but we cannot comment on that. We cannot comment on that because we don't have any information about their variances and other things. Okay. Okay, I'll provide the theory solution. Okay. So laser treatment, nothing we have here. So we'll just say is increased ability for laser treatment to customers. Okay. Overall, sales volume variance is favorable for Clearco because to achieve this, prices have been reduced. Okay. Overall, the sales volume variance is favorable. Now, concluding part. How do we conclude? How do we conclude? So let me tell you. We need to conclude about their sales performance, right? Okay. So finally, volume is 12,000 favorable. Price is 653 adverse. Okay. So what's your conclusion? Is it good or bad? Is it good or bad? Come on, guys. Is it good or bad? Our volume is 12,000 favorable. We'll conclude on the basis of final figures, which means we have reduced our prices very much. We have reduced our prices very much. We have reduced our prices very much, but our quantity is not that good. So when it comes to conclusion, how will we conclude? It's very simple. If you net off mix and quantity, you get 12,000 favorable, right? Favorable. And if you net off volume and price, so you get to understand the performance is not good. Not good because your price is very much adverse. You reduce your price so much that your quantity or volume hasn't increased that much. Okay. So let's write here. Overall, the sales volume is favorable because to achieve this, prices have been reduced, resulting in significant adverse sales price of 653,000. These results are disappointing and Clear Company may have to rethink its strategy moving forward. So they have to rethink their strategy moving forward because overall performance is not good. They are facing a lot of pressure. They have increased lots of prices due to their giant competitor and volume hasn't supported that much. So quick is what you have followed here. How you wrote. So one by one you started with the price variance, write the figure, tell the reason, volume, write the figure, tell the reason, sales quantity, write the figure, tell the reason, sales mix, write the figure, tell the reason, and if there is any interdependence, just mention that. As I mentioned here, reduction in price resulted in increase in quantity, okay, and then conclude on the basis of final figures that you have seen I have done here. The conclusion, I did consider mix and quantity because that's volume, okay. So my conclusion included volume variance which covered mix and quantity and the price variance as well. So collectively, I've covered everything which is relevant for the conclusion. Okay. Okay. For final performance assessment, we can net off to understand. Okay. As you see here, uh, sales price is adverse, volume is favorable. If you do a net off here as well, so you will feel that the performance is not good. Okay, so you can net off that, but it's not compulsory to net off every time. The numbers are very much clear, you can understand the performance is not good. Okay, so guys, are you clear about this? Say yes or no. So did my technique of crick help you out? Did my technique of explaining and writing in a paragraph help you out? You can use headings if you want to, no issues. Did I make this easy for you to handle? Okay, you're right. I will share the answer sheet on WhatsApp groups, okay? So did you like the technique? Guys, tell me. Quick. Honestly, if you read the examiner answer, that is so confusing, and you just follow this technique that I told you, it will make things very simplified and easy to write. You need to practice and write. That's it. How you calculate the variance? Kiran, I just showed you every working here, how I did the calculation of variance. Okay. Okay, so I hope this is clear to all of you friends. The calculations has been done. Theory drafting is clear. Theory drafting is clear. And I hope this will help you a lot. Okay, now we are done with this part as well. So we are done with sales mix and quantity. I hope CRIC did play a major role. And remember this technique, you can use this technique for all the drafting, whether it's planning and operational, whether it's material mix and quantity, you can use everywhere this technique. Okay. Now, I'm moving towards planning and operational area. And as I mentioned, I will take 5-10 minutes more today. Okay. I hope that will not be an issue for you people. And I'll show you how to quickly work out very easily planning operational variances. Okay. Now, let's start with this one. And in the end, I'll give you a very awesome plan today how to cover up the other areas. So be with me till 7:15. I'll just take 15 minutes more. I hope that will not be a problem. Yeah, I will share the link for material mix and yield as well. So be with me till the end, guys. I hope you are I hope you all are understanding things easily and session has went well for you people. Okay. So honestly tell me the theory technique was good. Okay, thank you. Now, planning operational variances. You should know what planning variance is. Planning variance is one that basically focuses on planning errors, which means at the time of setting the standards, at the time of setting the standards, if we have made anything wrong, if we have made a wrong standard, so that is known as planning error. Operational variances basically reflects the real performance of the managers, real performance. It reflects the real performance of the managers, okay? Now, the normal formula of labor rate variance and efficiency is here. And this formula is a one where we ignore the planning error. And let's now move on towards a question. Now, I will explain this through a very good question of exam, and we'll try to make this again really easy for you to handle. Okay. Okay, let's start. And before I start, $1,000,000 technique. Quickly, just listen what I'm saying. A very good $1,000,000 technique. For planning and operational. What is the $1,000,000 technique? Number one, while reading the question, when you're reading the question, find uncontrollable factors. Okay, uncontrollable for whom? For operational management. Now, what is operational management? What is operational management? Purchase manager, production manager, sales manager. These are operational management. Okay. So when you are reading the question of planning and operational, remember what you need to do. What you need to do? You need to, come on, tell me, you need to find uncontrollable factors, things which are not under the control of sales, purchase, or production manager. Now, once you find out uncontrollable factors, just revise the standard for them. Just do what? Just revise the standard for them. Okay? Just revise the standard for them. Okay? That's it. Very simple. Very simple approach. So, let's read the question and let's find any uncontrollable factors. And whenever I'll find it, I will revise the standard. Okay? So let's start. Be with me. Glove company makes high quality handmade gloves which it sells for an average of 150 per pair. This is the selling price. The standard cost of labor for each pair is 42. Standard cost of labor means what? One pair cost of labor is 42. One pair cost of labor is 42. And the standard labor time for each pair is 3 hours. Okay. So this means what is given to you here is, just very quickly listen, this is your original standard. So you will write very easily original standard, okay? And the original standard is 42 is the cost per glove, which requires 3 hours. Okay. Now, can you tell me what is the rate per hour? Can you tell me the rate per hour? Yes. Anyone? Okay. So you can work out that. 42 is the cost per pair divided by 3 hours means rate per hour is 14 per hour. Yeah. 14 per hour is the rate. 14 per hour is the rate. Is this clear to everyone? Okay. Right. 14 per hour is the rate. Clear? Happy? Okay. Now, let me use the spreadsheet as well. I'll be using the spreadsheet to make it very easy for you. So here is my spreadsheet. Here is my spreadsheet. Okay, it's opening. Let it open until we'll read the question. Okay, so I hope this is clear. 3 hours and rate per hour is 14. In last quarter, the company had budgeted production of 12,000 pairs, although actual production was 12,600 pairs. Okay, in order to meet demand. 37,000 hours were used to complete the work and there was no idle time. Okay. The total labor cost for the quarter was 531,930. Okay. At the beginning of the last quarter, the design of the gloves was changed slightly. Now, come on, find out something which is not in your control. Tell me. The new design required workers to sew the company's logo on the back of every glove made, and estimated time to do this was 15 minutes for each pair. Come on, tell me, is this under the control of production manager? The new change in the design. Come on, if you are the manager, you decide. If you are the manager, is this in your control? Will you take the responsibility of this new logo design? You will not. Now, those who are saying yes, I don't know why they are saying yes. Because it's not your responsibility. This is a change in the design, and it's the work of design team. It's the responsibility of the design team. Okay? So you will not be responsible for that. Okay? So you are not responsible for that. So once you are not responsible for that, just revise the standard. Just revise the standard. Okay? Getting the point? So let's do it. Here is my spreadsheet. And yeah, here is my spreadsheet. So see, no part here. I'm just doing a simple thing. Is that what I'm doing? Let's see what I'm doing. I'm writing the original standard of how much it was. I did work out the original standard. It was 3 hours, right? And the rate was 14. Okay. Now the revised standard. So, guys, be with me. It's very simple. Okay. Now, do you think this is not in the control of the manager? It's not in the control of the manager. The new design change is not in the control of the manager. Okay. So, should we revise the standard? Yes. If you are the manager, you will not take this responsibility and you want to revise the standard. So what now the new standard will be? 15 minutes will be required for the design logo. Okay. For the logo, 15 minutes will be required. So if I convert 15 minutes into hours, so how much is 15 into hours? It's 0.25. Okay. It's 0.25. Agreed? So this will be how much? 3 plus 0.25. It's 3.25. Okay. 3.25. Agreed? 3.25. Okay. Let's move on. Let's see what next is written here. However, no one told the accountant responsible for updating standard cost card that the standard time per pair of gloves needed to be changed. Similarly, although all workers were given a 2% pay rise at the beginning of the last quarter, the accountant was not told about this either. Okay, pay rise not incorporated into the standard. Is it the responsibility of the production manager? Do you think production manager will be responsible for that? Say yes or no. No, you all are saying no, not responsible. Exactly not responsible. Okay. So should we revise the standard as per my $1,000,000 points? Yes. Okay. 2% pay rise. So let's go here and incorporate 2% pay rise. Okay. Okay. 14.28. 14.28. Right. So what I've done, I've increased the standard here. I have increased the standard here, and this is 14.25. I hope you all are clear about this. I've increased 2% into the rate. You got the point? So now, mark my words. If you are able to write down the revised standard, your question will be a piece of a cake. Mark Rizwan Mania's word. If you are able to identify the uncontrollable factors and if you revise that, your answer will be solved very easily. Very, very easily. Okay? So guys, is this $1,000,000 technique okay? Come on, give your responses. While reading the question, what are we supposed to do? We have to find uncontrollable factors. For whom? Come on, tell me for whom. Come on, friends. We have to find uncontrollable factors for operational management. So what is operational management? Purchase manager, production manager, sales manager. Once you find uncontrollable factors, just revise the standard. Just revise the standard. And your work is done. Because you are not responsible for that, just revise the standard. Okay, so let's start with the first requirement. Consequently, the standard was not updated to reflect these changes. Let's start with a 2-mark requirement. Calculate total labor rate, total labor efficiency variance for the last quarter. Okay, so what we have to work out? We have to work out total labor rate and efficiency. Okay, now is your cost card, is your current cost card incorporated these changes? The answer is no. Your current cost card didn't incorporated the changes, right? Which means labor rate and labor efficiency will be worked out using the original cost card. Will be worked out using the original cost card. Is that right? Yes. Which means you will work out using the original cost card because nothing has been incorporated into your standard. So let's use the basic formulas. Part A, labor rate, labor efficiency. For labor rate, let's use the basic formula. What is the formula? Quickly, original standard rate per hour minus actual rate per hour into actual hours paid. Okay? Right. Labor efficiency, standard rate per hour into original standard hours allowed minus actual hours worked. Now, how do we work out standard hours allowed? So the formula is standard hours per unit into actual units. Okay? So you have to use the basic formula. Nothing will be considered here about the error. Basic formula. Okay? So let's work out using this formula. Try to understand the formula, how you have to input into the cells. You don't have to write the formula. Bracket open. What is the original rate? 14 minus what is the actual rate? Let's go back to the data. Where is the data? Yeah, here it is. Cost is 531,930. Hours are 37,000. Okay, 37,000. So 531,930 divided by 37,000 hours, bracket close. Okay, everything in the same cell. Standard rate minus actual rate into what? Into the actual hours, which are 37,000. Okay, so as you can see here, everything is very much clear. Standard rate is 14 minus actual rate I have worked out here, multiplied by the actual hours, and the variance is negative. If it's negative by default using my formula, it's adverse. It's adverse. And adverse means what? The actual rate paid is more than the standard. The actual rate paid is more than the standard. Getting the point? Okay. Now, labor efficiency. Formula is, and you've seen the formula here. Let's find out using the normal formula, right? Standard rate per hour. Bracket open. 14 multiplied by another bracket open. Just understand how to use the brackets. Okay, so now you can see here what I'm doing. 3 hours. I need to work out standard hours allowed, right? So the standard hours are 3 multiplied by actual units. So how many are the actual units? 12,600. Yeah, 12,600. Okay, 12,600. Bracket close. So these are your hours allowed. These are your hours allowed. Minus actual hours of 37,000. Okay. Now remember, the more brackets you open, you have to close those as well. So you can see here, clear? And the answer is 11,200. If you want to check the workings, have a good look here. Standard hours allowed minus actual hours into the rate. If the answer is positive, it means what? It's favorable. Come on, guys, it's favorable. Okay, it's favorable. Why favorable? Because you took less hours than the budget. Okay, great. Now, done with first part, 2 marks. Part B. Analyze the above variances into planning and operational in as much detail as information allows for 6 marks. Okay. Now, you tell me, was there a planning error in rate? Was there a planning error in rate? Okay. Was there a planning error in rate? If yes, this means we will work out labor rate planning. Okay, and we'll work out labor rate operational. Right. Now tell me, was there a planning error in hours? The logo, hours. Yes, come on, say yes or no. If yes, so we'll work out labor efficiency planning. Okay, and labor efficiency operational. Okay, so whenever you see a planning mistake in any area, you split that into planning and operational. You break that into planning and operational. Why? Because you as a manager will not accept the planning error. So that is why we separate the error component under the heading of planning variance, and we separate the operational component under the heading of operational variance, so that we can easily check the performance of the managers. Because managers will not accept planning errors, that is why we separated. Okay, great. Now how will we be able to find out the answer in the most easiest way? So please be with me, it will not take much time. Here we are. I'll make this really easy. Labor rate planning. Original standard versus revised standard. OR. Original standard, revised standard. Operational variance. Revised standard minus actual. Okay. Revised versus actual. So see, these are in red. So how can I find out a shortcut? Is original versus revised is planning, revised minus actual is operational. So what is the shortcut for me? A versus R for planning, R versus A for operational. Are you getting the shortcut, friends? Come on, tell me, yes or no? Come on, tell me, yes or no? Okay, so planning variance is what? Original standard versus revised standard. Original versus revised. What is operational? It's revised versus actual. Revised versus actual. Are you getting the point? Come on, give me your feedbacks. So learn the shortcut. What is planning variance? O versus R. Come on, write O versus R. What is operational variance? Write it down. R versus A. R versus A. Yes, great. So let's do this. Formula is very clear to you. Simple. Let's quickly do the changes. So see how I'll do this. I'll copy the rate variance formula. See the magic. I'll copy the rate variance formula with Control C. We'll paste here and we'll paste here. Wow. Wow. So you will say it's the same answer. Yes, I know. Yes, I know. The answer is same. But now I'll make the necessary change. And what's that? Let's open the cell. Let's start with operational first. So what's the formula? Revised standard minus actual. Okay. So let's go to the formula. And this is the formula, right? Now, revised versus actual. So what I need here is, I need revised. Instead of 14, I'll write 14.28. 14.28. Revised minus actual. And you have the answer. Wow. You have the answer. Are you getting the point? Is it easy? Come on, guys. A small change. I just made this original revised. That's it. And you got the answer. Clear? Now, second, rate variance. So what's the formula? Original standard versus revised standard. It's original versus revised standard. Okay? So now, let's make the necessary change. Original is how much? 14 minus how much is revised? 14.28. 14.28 is revised. Getting the point? Original minus revised. That's it. Here you go. Wow. Answer is clear. Now, if answer is negative, it's adverse. It's adverse. If it's negative, it's adverse. If it's positive, it's favorable. Mathematically. Now you can check the answer as well. You just net off these two. Just net off these two. and see what are you getting. Yes, are you getting 13,930 as your answer? And here you see, yeah, magic, easy. Is it easy? Tell me. Simple changes I'm doing. A versus R versus A. That's it. That's it. Okay. Now, the last thing, labor efficiency. Let's copy. Let's paste here. Let's paste here. We're about to end. Okay. Okay. 14.28. I just worked out by increasing 14 with 2% pay rise. Okay. Now, let's make the necessary change. Let's look at the formula. Revised standard hours allowed minus actual hours. Revised standard hours allowed minus actual hours. Okay. And here, original standard hours allowed minus revised standard hours allowed. So see, it's the same thing. In operational, it's revised versus actual. And in planning, it's original versus revised. Same thing, original versus revised. Okay. So let's start with efficiency first. Revised versus actual. Now, is this the formula? Yes. Let's make necessary change. And what's that? We just need revised standard here. So instead of 3, what will I take? 3.25. That's it. Wow. 3.25. Revised versus actual. Are you getting the point? Okay. That's it. 55,300. 55,300. You are getting the answer here. Okay. 55,300 is the answer we are getting here. Clear, friends? Only small change I made here. Now it's time for this one. So what is the formula? Original versus revised. A versus R. A versus R. So what is original versus revised? So let's make the necessary change. Are you ready? Okay. This is the formula. So now I just need here revised, right? So I'll open up the bracket. I'll open up a bracket, and 14.28 is the revised. Sorry, I beg your pardon. 3.15 is the revised into the actual number of units, and I'll close the bracket. Can you see the workings here? What I've done? Original was 3, revised is 3.15. That's it. Original standard hours allowed minus revised standard hours allowed. That's it. Sorry, I beg your pardon. It's 3.25. Yeah. Okay. Agreed? Simple, easy. That's it. That's it. Clear? If the answer is negative, it's adverse. If it is positive, it's favorable. Right. O versus R. R versus A. Fantastic. Let's cross check. Let's 11,200. Are you getting the same figure here? The answer is yes, 11,200. Easy. Easy. O versus R for planning. R versus A for operational. Okay. So yes, here we are. This is clear to all of us. Very quickly, the last thing, if efficiency, labor efficiency is operational is favorable, so what it means? It means that less hours used than the standard revised. Okay. If planning is adverse, so what it means? If planning is adverse, what it means? It means that the original hours are less and revised have increased. Okay, we believe in revised standards. So in case of planning variance, when revised is more per hours, it's adverse because more hours will be required. Okay. For operational rate, it's adverse, means your actual rate is more than the revised rate. Okay. When labor rate variance planning is adverse, so what it means? It's the same thing. If planning is adverse, it means that your revised rate is more than the original rate. Remember, my friends, in case of planning variances, for cost planning variances, for cost like material and labor, for cost planning variances, if revised is more, than the original for cost, if revised is more than the original for cost, it's adverse. If revised is less than the original for cost, it's favorable. Because we believe in revised standards more. Because revised standards are more realistic. So if they increase in terms of cost, it's adverse. And if they go down, it's favorable. So I hope this is clear to all of my friends here. And the calculations are simple. I hope I made this easy using R versus O and O versus R and R versus A. Okay. Now, okay. Now the last part is theory, which you can solve using the technique of Crick again. So make sure you can use Crick again. You know how to do it. And yes, for that, my friends, remember Crick is what you'll be using here. So keep this in your mind that I will be sharing the $1 million plan today on your WhatsApp group, where I'll be giving you good links of the topics that we haven't covered today. You do watch those topics. For example, if you need in-depth understanding for mix and yield and its theory, I'll share the link. If you need planning operational for material variances, I'll share the link. That all will help you. If you need to understand learning curves in depth, I'll share you the link. Okay. So I hope this is clear. What's that written at the last? Sir, can you repeat it again? Okay, how? Okay, so R versus O, A versus R is what I've explained to you here. Sorry, O versus R and R versus A. For planning variances, Fatma said, if in case of cost, if revised is more than original, it's adverse cost, because your hours revised are more and original are less, so it's adverse. Okay, so that I was mentioning there. Now I hope this is clear to all of you. A quick word for today's session. I know I've exceeded 15 minutes, but this was all for you. Quickly give me your feedbacks. How was the session today? Everybody, did you understand the entire plan, the theory, calculation, spreadsheet? Come on, tell me. How was the today's session? How will you rate 1 till 5? 5 being the best, 1 being the worst. How will you rate it? Come on, tell me, guys. Okay, great. So thanks for your feedback. Thank you very much. Do give your feedback to ACCA as well after the session. This is my WhatsApp number. If you are not part of my group, please send me the WhatsApp message. I'll share the link with you people, and I will give you the links for these topics and the question and the answers. Everything will be shared on the WhatsApp group. So please be part of that. Tomorrow we'll be covering decision making, very important topic, decision making. Be part of tomorrow's session as well. And one more thing, the last one for today is I will be giving you a very good homework question on the WhatsApp group. You have to solve that homework till the tomorrow's class. Thank you very much for that session. See you tomorrow, same time. Until then, take care. Bye.